Got over 60 with a checking account? 3 IRS enforcement changes went into effect this year, and here's what nobody's talking about. You weren't notified. There was no mailed warning, no headline, nothing official sent to your door. Instead, these updates showed up quietly in enforcement guidelines and compliance documentation, and right now, the vast majority of seniors don't even know they exist. I'm walking through all 3 in this video. The dollar amount you thought kept you safe that doesn't anymore, the everyday banking move now being watched as suspicious behavior, and the common family money exchange that could suddenly become reportable income. Make sure you watch until the very end. That third one is the risk you might already be facing right this second. I'm Claire Weston. Every week, I walk you through financial and legal updates that genuinely help you safeguard your money and simplify how you handle retirement. If that sounds valuable, hit subscribe now so you catch everything I put out. Let's start with rule number 1. For years, the figure burned into most seniors' minds has been $10,000. Keep your transactions under that line and you're clear. That belief no longer holds up. According to the Bank Secrecy Act, cash transactions exceeding $10,000 within 1 business day still require your financial institution to submit a currency transaction report directly to FinCEN. That report includes your full name, social security number, birth date, and transaction timestamp, all filed within 15 days. You won't receive a copy. In fact, your bank is prohibited by law from disclosing it to you. Here's what shifted in 2026. The IRS is now focusing attention below that $10,000 mark. New guidance directs monitoring toward accounts displaying repeated deposit activity just under $10,000, particularly from seniors collecting regular benefit checks, family contributions, or retirement account withdrawals. The magic number isn't shielding you anymore. It's the pattern surrounding it that matters now. There's another form of reporting most people over 60 aren't aware of, one without any minimum dollar requirement. It's called a Suspicious Activity Report, or SAR. Your bank can file one based on a transaction as small as $200. These get triggered by compliance algorithms tracking behavior instead of transaction size. And again, you're never informed. Bank employees face criminal penalties, including up to 5 years imprisonment, for disclosing a SAR filing to you. Here's something else worth noting. Money orders and wire transfers above $3,000 require your bank to verify and log your identification under this same framework, even when no formal report gets submitted at that amount. It creates a smaller paper trail under the same monitoring system the government maintains. These regulations apply equally to credit unions and major banks. There's no carve-out for community institutions or smaller financial organizations. If you moved your money to a credit union, assuming it operates under different rules, it doesn't. Any federally insured institution must comply with identical Bank Secrecy Act standards, so your smartest strategy isn't hopping between banks. It's learning exactly what behavior prompts a filing. Which brings us directly to rule number 2, the change that turns routine banking into a compliance issue. Consider Diane, age 67, formerly a county clerk in Albuquerque. She'd been pulling out $800 in cash every 2 weeks to cover household costs for 11 years straight. When her husband died, she bumped that figure up to $1,000 to manage expenses he'd previously handled. 6 weeks after that adjustment, her bank's monitoring system flagged her account and generated a SAR. Diane had done absolutely nothing illegal. She was simply a widow updating her budget, but the algorithm interpreted her consistency as potential evasion. Diane remained unaware of the SAR for months, until a standard account review at her bank surfaced irregularities connected to that earlier filing, prompting a compliance officer to question her about the shift in her cash withdrawal habits. She managed to resolve it because she'd kept old receipts demonstrating that the increase aligned with new expenses she'd assumed after her husband passed. Still, she told me she had zero idea anything had been reported on her account until that exact moment. This falls under what's called structuring. It's addressed in Title 31, Section 5324, and intent isn't required. All that matters is whether a pattern appears designed to avoid hitting the reporting threshold. Repeated withdrawals of similar amounts staying below $10,000 meet that definition, no matter where the funds originated or how legitimate they are. If cash is part of your regular routine, the solution is documentation. Keep a brief record each time noting the date, the amount, and what it's for. When moving larger amounts between accounts you own, execute it as a single transfer rather than breaking it into smaller chunks. Before we get to the last rule, pull up your transactions from the past 90 days. If you spot 3 or more deposits falling between $5,000 and $9,500, make a note. You'll need that information for the action steps coming later. Now for rule number 3, the one that involves money you never considered income. Maybe your daughter sends $400 via Zelle to help with groceries. Your son transfers $600 through Venmo to cover a car fix. None of it seemed like taxable income, but revised 1099-K regulations now require third-party payment platforms like Venmo, PayPal, and Cash App to report total incoming payments to your account once they hit a specific yearly threshold. For 2025 activity, that threshold is $2,500, gradually lowering towards $600. Zelle operates under different mechanics because it functions as a direct bank-to-bank transfer, which means it's not covered by the same reporting requirement, though the money itself remains taxable if it genuinely qualifies as business income. When a payment processor reports those transactions and they're missing from your tax return, the IRS system automatically detects the discrepancy. The notice you'll receive is a CP2000, which isn't technically an audit, but a proposed correction that includes interest. Patricia, 71, a retired home health aide living in Memphis, received one this past March stating she owed $1,840. She hadn't earned income all year. Her 3 grown children had collectively sent her $3,200 via Venmo to help with prescriptions, utility bills, and replacing her refrigerator. The IRS cross-referenced the $1,099K with her filed return and identified a shortfall. She had 60 days to reply before it converted into an automatic assessment. The solution: ask family members to include personal gift in the memo field whenever they send you money, and maintain a basic log. Gifts don't count as taxable income for you, but you must be prepared to prove that's the nature of those transfers. Here's one more critical detail many seniors overlook. The IRS typically has 3 years from your return filing date to audit or challenge it, but that statute of limitations extends to 6 years if unreported income exceeds 25% of what you actually declared. That means a payment app discrepancy from 2 or 3 years back could still resurface now, even if you never got a notice back then. If you've been getting consistent family support through these platforms for several years without documenting it, consider pulling your transaction history for the past few years, not only the current one, so you're not blindsided by a notice addressing a year you've already put out of your mind. Here's what I need you to do next. The exemptions, the tax breaks, the refunds seniors already qualify for but almost never claim, I've compiled all of it into one resource, broken down state by state, form by form, so you're not burning hours searching through confusing government websites. Everything's organized clearly and quickly, designed so any senior can immediately identify what applies to their situation. Regardless of where you live, there's money sitting unclaimed that belongs to you. It's called the Senior Exemption Playbook. You'll find it in the first pinned comment directly under this video. Just click it once and you'll have instant access to everything you need. Don't click away yet, because this final rule is the one most seniors are unknowingly exposed to right now. And it's exactly why I created this entire video. Here's your complete action plan, and follow these steps in this exact order. Step 1, request your free ChexSystems report and review it for any flags or account closures you didn't know about. Step 2, for the next 90 days, create a log of every recurring deposit noting the source, amount, and date. When family members send money via an app, ask them for a single sentence confirming it's a gift. Step 3, consolidate any upcoming transfers between your own accounts into one transaction instead of multiple smaller ones, and include a short memo explaining the purpose. Step 4, total up every payment you've received over the past 12 months through Venmo, Zelle, PayPal, and Cash App. If that sum exceeds $2,500 and it's not reflected on your most recent return, start organizing your documentation right now before a CP2000 notice lands in your mailbox. Step 5. If a CP2000 does arrive, submit your written response before the deadline printed on the notice, typically 60 days from the notice date, not from when you actually opened it. Include a clear explanation, supporting documents, and your signed statement. If the proposed liability exceeds $5,000, bring in a licensed tax professional before you respond. Step 6. Put a free security freeze on your ChexSystems file if you're not planning to open new accounts anytime soon. It won't impact your current accounts, but it does restrict how your banking patterns get circulated through screening systems moving forward. None of these 3 changes arrived with any advance notice. Your bank isn't allowed to tell you when a SAR gets filed, and the payment app won't alert you when it reports transfers from your family. That silence is intentional and embedded in federal law. Understanding these actual rules and keeping proper documentation along the way is what prevents a quiet flag from escalating into a serious issue.